everyone, it's Alan, coming back at you from the depths of the Personal Finance Vault with another video. For today's video, we are going to be talking about securities. What you need to know to get a basic understanding of what a security is, how it relates to the world of investing, as well as a real-world example will be presented to you by me on only one sheet of paper. Let us begin. In its most basic sense, a security is an investment that can either provide the holder with an ownership or debt stake in a company. Typically, a company would offer securities in order to raise capital to fund improvements for the business or in order to sustain its current model. The two most common securities that are presented to prospective investors are what we would call stocks or equities and bonds, which are also known as fixed income. These securities are generally available to investors through an exchange or an over-the-counter market. Investors purchase these securities in order to gain a profit, or easier said, to make money. Investors can make money through an ownership stake by selling that stake to another investor for a higher price than what they had initially purchased it for. So for an example, we have a XY axis of money and time. If we purchase the security at the beginning of our time for this amount, we're going to hold that security. It's going to travel up, it's going to go down, it's going to be volatile. All of a sudden it breaks out and then we sell it here. The difference between what we paid for it and what we sold it for is going to be our profit. Investors who have purchased a debt security will receive compensation or interest from the company either upfront or throughout the set of time the issuer says, and then the initial deposit will be returned after said amount of time. For example, on a debt security, a prospective investor has a certain amount of cash and then they buy a debt stake in that company, so they lose their cash. Throughout the period of time, the issuing company will pay them interest on that amount of cash that they paid them, which is visible here, moving up. And then at the end of the issuing period or the set time that the issuer had stated, they're going to receive all that initial cash back that they gave the issuing company, and then the total difference when we add up all of the interest payments plus then the cash that they received and then subtract the cash that they lost is going to be our profit. Or other way, just the interest that is paid is going to be the profit on the debt security. So for a real world example, we are going to look at the professional soccer player transaction industry. What may not be commonly known is that there is a gigantic money-making opportunity for the exchange of players between clubs in professional soccer. We are going to look first at an ownership or equity stake transaction that occurs, and then we will move on to a debt stake. For a simplistic example of an ownership stake with players, think about the clubs being the companies and the players being a security. What we have here is we have three clubs. We have Club A, B, and C. And we are going to follow these clubs and a player transaction of player Z through 4 years. In year 1, player Z is playing on Club C. At the end of year 1, Club B liked what player Z was doing and wants that player to be on their team. So in year 2, they are going to acquire player Z and they're going to pay cash to Club C for that player. Player Z will then play for the club in year 2 as well as year 3. And at the end of year 3, player Z has been nominated as the most valuable player of the league. This catches the eye of Club A, and now they want player Z to be on their team. So they're going to pay Club B cash for player Z to be on their team. As you can see, Club B has exchanged in an equity or ownership transaction. They paid Club C $1 for player Z and then sold that player for $3 to Club A, with $2 being their profit. Now, let's look at a debt stake in the world of professional soccer. Many teams have developmental programs for their players. What can happen, however, is that a player has shown signs to be great but isn't quite ready for the spotlight. So what they will do is they will go out to the market and ask other clubs if they would like to loan the player for a certain set of time for cash. So what we have here is we have player X on Club A in year 1. In year 2, Club A realizes that player X won't be getting playing time this year, but some other club may find value in that player. So what they do is they go to the market and Club B says, we will pay you $2 to have player X for year 2. Club A says that's great, but we want him back next year, and Club B agrees. So player X has now on Club B for year 2, and Club A got cash. At the end of year 2, player X will move back to Club A, and Club A will have both player X and the cash that was paid up front. This would be an example of a debt stake in a company or a transaction. I hope this video has been helpful on explaining what a security is. I will be going deeper into stocks and bonds in a future video. But in the meantime, if you could leave any questions or any future topics you'd like me to go over in the comment section below, I would appreciate it. Till next time, this has been One Page Financial.